Homeowners, you could be sitting on a proverbial gold mine when it comes to the equity in your property. You could be using it as a wealth accelerator. I'm sitting down with Willis Richardson of Pure Funding, and we're going to get started right now. So this is a topic that we are talking a lot about these days. Typically, when rates start to teeter on the way down, people start to think about, hey, how can I leverage the equity in my property? And we've talked about cash out refinances from a standpoint of eliminating debt, right? Looking at a kind of a blended rate strategy. How do you improve your cash flow by eliminating high interest debt? Yes, you may be increasing the interest rate on your property, the loan on your property, but you're eliminating high interest debt. Therefore, you're increasing your monthly cash flow. We're going to take a different look at it today and think about it more of like, hey, you're sitting on a bunch of money, a bunch of equity in your property. How can you use that as a wealth accelerator to improve your financial situation going forward? So I guess the first question is probably the number one objection we get from anybody that comes to us and says, hey, I need access to capital. And we're like, well, you should look at a cash out refinance. Like, no. I don't want to touch that loan. Why do you think cash out refis have such a bad rap?
So a lot of times, like we've talked about in the past, the majority of reasons people do a cash out refinance is one of two things. They're either paying off high balance credit card debt or they are doing a home renovation. It seems like those are the two reasons that people primarily do a cash out loan. And those are great reasons to do a cash out loan. But it gets a bad rap because I think one, people are kind of seeing that as, okay, I have all this other debt that I'm having to pay off, and now I'm having to give up this 2 or 3% interest rate and trade that out for 7. And even though we've talked about how cash flow is better and overall their net rate, when you look at taking away a 28% credit card in replacing it with a 7% interest rate over a longer term period can save you thousands of dollars a month. It's still, there's something there in that mentality of I have to pay off my home. You know, the majority of people actually only own have a mortgage. The average life of a mortgage, I believe, is like 7 years. It used to be. It might be even shorter now after 2020 and 2021. But let's say it's 7 years. In 7 years, you're going to move most likely. The home, once that equity is sunk into the home, there's nothing that you can do to use it. It's nice to have for when you sell, but what if you could get access to it before then to actually increase your wealth in other ways? And that's what I really wanted to focus on today is strategies that you can use a cash out refinance. And yes, you might end up getting a higher interest rate, but if you can increase the money coming into your pocket to offset that higher interest rate, you'll be better off in the long run. And that's what we want to look at.
I think the kind of the way to think about this is, accessing the equity in your property is really a means of accessing some low cost capital, right? If you're
that's the key word,
low cost capital, right?
Capital.
Like how else are you going to acquire this amount of money at this interest rate in what could be, a fixed term over, 30 years? Like it just doesn't exist. Money's not that cheap when it comes to trying to access capital for other purposes in your life. So, when we think about the number one question is obviously, well, how do cash out refinance rates compare to other borrowing options? And, I think we go the traditional route in a lot of the conversations. Well, let's look at a HELOC. Let's look at a HE loan, home equity loan. And, those rates are going to be more. They're going to be higher. They're going to cost more in a monthly payment strategy. And yes, does a HELOC give you some flexibility? Sure. I think we can contain that loan purpose off to the side for a bit. But, when people are looking at a cash out refinance and they're hesitant, outside of the increased interest rate and their increased kind of monthly payment, what are the other risk factors that people could run into when leveraging their property in a cash out refi?
There isn't a ton of risk in them. They're a mortgage loan. You still have to qualify with your income. So we're not going to allow you to take out $400,000 if you can't make the payment. That's the role of a good loan officer. So really, there is going to be a higher monthly payment if you're not using it to necessarily pay off debt that's lowering payment somewhere else. But outside of that, we can't use the potential new income that you're thinking about creating to help qualify you for this loan. So you're not going to get into a loan that's over your head. You are going to be stepping back, and you used to owe 300,000, now you owe 500,000 on it, but you still have the payment that you're going to be making every single month, that is in line with what your current income is. If you can't afford a $500,000 loan, then you're not going to be approved for it. So there really is very low risk to getting this capital. But the best thing about it is comparatively, it is going to be the lowest cost for getting capital that you can get, because a business loan, a small business loan, those are going to have much higher interest rates than what a cash out refinance on your home will have. And that's the thing that I just wanted to stress today, is that people would know that you could probably get cash to do all kinds of things to grow your wealth, and that cash might be as cheap as 6 to 7.5%,
Yep.
somewhere in there. As rates continue to drop down, I think that will go even lower. But right now, that's
Do you
where it
have
would
some
be
like
at.
real world examples that we've run into where people have leveraged the asset in their property to kind of build their wealth? I mean, whether that be through investment properties
Yeah.
or other avenues?
The And maybe it's because investment properties are also real estate, and you're dealing with a
Yep.
real estate asset. That's where the
Yep.
majority of people go. There's about 4 different ways that you can leverage the equity in your home to make money for yourself. And like I said, if that money coming in each month is more than what your increase in your monthly payment is, then
Doing well.
you're in the red. Oh, sorry, you're in
Yep.
the you're
In the
doing
black.
well. You're in the black. You're not
Yep.
in the red. You're in the black. So yes, number one way that people do it is they take money out and they use it as a down payment to do investment properties or fix and flips. And both of those opportunities have great returns. If you're doing a fix and flip, you're going to get money in a shorter amount of time, and it's going to be a larger amount. If you're buying rental properties, you're going to get an income stream, that mailbox money that people are always talking about. You're going to get that coming in at the same time that that asset is appreciating. So that is typically a much longer play. Have the property 5 years, hopefully it appreciates tens or hundreds of thousands of dollars. You sell it and then you move on and do it again. You can use the money to boost your investment portfolio. If you have some stocks that you're investing in that are giving you an annualized rate of return that's higher than what that 7% interest rate is on your mortgage, it's going to be a net benefit. If, let's say you have a new business idea and you don't necessarily have experience in that market, it's going to be really hard
Yeah.
to get an SBA loan. If you don't have assets, those SBA loans are always looking at assets. If you don't have the assets, they're not going to be able to approve you for that. But if you have equity in your home, you can take that out, and it'll be a great low interest rate that will give you the ability to start that dream job that you've always wanted, or start that new product line that you've always dreamed about. And that's what's really cool to see, is when people can take that step and can move in that direction and start something new, with the equity in their house being the seed money to make it happen. The final thing that you see people do is they invest in themselves, either through education or some kind of skills development, some kind of class, some kind of certificate. They can take that money out, put it towards bettering themselves, and then now they can go and get a higher paying job. They can go and, I don't know, start medical school. I wouldn't, because I'm old and you
That
don't
ship
want
has
me
sailed.
cutting on you. That ship has sailed. You could be whatever you want to be, they used to tell me. But as you
Yeah.
get older, those
Yeah. You gotta
options
stay in
get
your
chopped
lane.
off. So, but yeah, you got to stay in your lane. But I will say there's definitely certificates that people can get. They might be at that point, they're in their 30s or 40s, and there's still time to make a job change. That's what I did. I started doing mortgages in my 40s. I think there's a lot of benefit to seeing how the equity in your home can just start new aspects of your life and change things
Yeah, I
for the
think
better.
that in the most common scenario we hear, whether it be meeting in investor groups or just really some of our realtor networking that work with potential investors, is it's pretty cheap cash to go buy another property to fix and flip. It's pretty
Mhm.
cheap cash to go put down
Yep.
payment on a rental property. And you mentioned the SBA route. That process is exhausting. You are not going to gain access to that cash in a reasonable amount of time, it's going to be hard.
Right.
I don't know that I've
Yep.
spoken with anybody that says, oh, yeah, it was an easy process. I got what I needed. I'm off to the races. Whereas you're sitting on equity, it's your equity. We can get that turned around pretty quickly. I would say one of the questions is like, Clark, I don't know if that's for me. I think that I'm just too risk adverse to messing with the 30-year fixed rate that I have. Forget what the interest rate is. I know what the payment is. I'm comfortable with it. So I think it comes down to your risk profile as well. It's like somebody that's an investor isn't going to look at it. They're constantly going to be moving money around, right? Moving money to the next project. How do I get that project done faster and get the house on the market to flip and turn that money into the next project? I think, and you mentioned seed money. Like if you were wanting to do that, I'm personally thinking about doing this is like, hey, I now have resources now that I've been in the industry long enough where I've got resources to go do a fix and flip pretty easily. By that, I mean the people that are actually going to help do the work. So, access to cash is cheap. It's a pretty efficient way to get capital. And, in our area here, most people are sitting on a very large amount of equity. So there's a decent amount of money you can gain access to. I think the cash flow example that we talked to in our traditional cash out refinance scenarios applies here, right? If you're looking at a property and you want to rent it out, what's that property going to rent for when it's done? What's your cash flow going to look like after that scenario? Now, is that cash flow more than the increase in monthly payment of the rate you've adjusted to through your cash out refinance? These are the things you need to work with. So I do think, talking to your CPA, talking to your financial advisor about what you want to do and how you can possibly gain access to this equity is something you want to plan for. I mean, we're not saying here, hey, go grab 100% of the equity in your property and go, lay it all on a fix and flip and roll the dice. What we're saying is the money's there. It's yours. You've earned it. Access to it. For some people, it sounds painful. It's not painful. It's easy to do. It's easy to access.
Yeah.
It's a pretty easy process, right?
Because
Because we're dealing with a very tangible asset that we can leverage. So I'd say, the question is like, who is a cash out refinance not for? I would say somebody that maybe has too high of a risk profile. That's just like, hey, I'm going to access 100% of what I have here and I'm going to roll the dice. We would.
Yeah.
Don't take it to Vegas.
Don't take
us to Vegas. I mean, there's a reason, it's funny. I was just talking to a lender about our buy before you sell program. And we're talking about it allows you to access the equity in your property as a down payment for your next property. And they're like, just so we're clear, that money stays with us until the closing table, because we've had people disappear to Vegas and be like, oh, I got $300,000 out of my house. I'm going to turn that into 6 real quick and bet on red. We don't want to see that. We want you to be savvy. We're just saying that there is a considerable amount of wealth that you've built here. Take advantage of it. Yeah, I think it's something that we try and educate customers on. The other question is like, well, at what interest rate adjustment does it make sense, right? Like if I'm sitting at 3 and my new mortgage is going to be at 5, it's like there's not a simple answer to that question, right? It's really like, what are you intending to do with the equity that you're going to take out? And then, if it is debt related, obviously it's pretty easy to do the math on the cash flow. But if you're using it for investment purposes, you want to be a little bit more deliberate in what you're looking at.
Right. Exactly. If you're starting a new business, you want to know what a good idea, a conservative idea of would be on what your return is going to be on that business. You want to do your due diligence when you're going this direction. When you're paying off debt, you're exactly right. It's real easy to run those numbers and see if you're cash flowing better, to see if it's a good deal. When you're acquiring rental property, I think, like I said, that's probably the least risky because you're putting it into real estate that historically appreciates, sometimes better than other times, but historically appreciates. If you have a consistent rate of return on an investment portfolio, I think that is a little bit easier to be able to run those numbers. But at the same time, that is more risky than real estate. I think of the options that we've looked at, launching a new business is probably going to be the riskiest of the four. Getting a new master's degree in your industry, what that's going to bring for raises and job opportunities. You can quantify that pretty quickly as well. But outside of launching a new business or expanding your business, all of these are pretty conservative numbers that you can run. But like you said, you want to do the homework. You don't want to just jump off into the deep end and do a cash out refinance because you're going to start a new underwater basket weaving school and everyone's going to
seen
love
every
it
one
like
of those
you do.
fail. Underwater basket weaving.
I know. It's the worst. That's what my dad said my degree was in for years.
Go get them, Willis. Your underwater basket weaving degree is going to pay
Weaving degree.
dividends.
Dividends upon dividends. No, he never said that about my degree. He said that about other stuff, I'm sure, though.
Some of your class choices, probably. Yeah. How's that underwater
class
basket weaving
choices.
class treating you?
Exactly. Yeah.
All right. Well, this has been
yeah.
good. I think, what we're saying is the equity in your property is a dynamic asset that you have access to. And when thought about the right way, it can be a awesome tool to help grow your wealth. So reach out to us. Happy to have the conversation. Listen to your ideas, talk about scenarios, talk about what the market's doing. We're happy to have those conversations. We aren't just here to sit down and write loans. We want to be very consultative in the process. So reach out to one of our loan officers. We're more than happy to have that conversation. As a reminder, give us a subscribe, leave us a like. It really helps the video and all the content we're pushing out. Willis, as always, thanks so much for taking the time. We will see you again on the next video. Thanks, everybody, and have a great day.
Talk to
Bye-bye.
you later. Bye.